Welcome to PitchIt, the Fintech Startups Podcast. One founder, one startup, one investor at a time. I'm your host, Todd Anderson, Chief Content Officer, Fintech Nexus. Thanks again for tuning in to this week's episode of PitchIt. I recently sat down with Perry Rahbar, founder and CEO dv01. dv01 is a leading data intelligence platform with integrated loan-level consumer credit data and analytics that drives transparency in lending markets. During the episode, Perry talks about his time in banking and some of those lessons learned back from the global financial crisis. And really, dv01 aims to solve some of those structural issues that plagued market participants back in 07, 08, 09. The insight that you get from this type of data and the transparency it provides really allows those issues to get caught early. And so it avoids a Bear Stearns, a Lehman-type crisis. Perry and I talk about his time in banking, why he decided to start dv01, the meaning behind the name dv01, the evolution of fintech lending since he launched dv01, what a recession might do to the fintech lending markets, the recent acquisition by Fitch, adventures on the fundraising trail, visiting Iran, and much, much more. Before you begin the episode, please take a minute and rate or provide feedback on the show. I take ratings and comments very seriously and try to do my best to read them all. And don't forget to join us in Miami on December 13th and 14th for Fintech Nexus LATAM. It's LATAM's premier fintech event. For 15% off of your ticket, please use the code PODCAST. Without further ado, I present dv01's founder and CEO, Perry Rahbar. I hope you enjoy the show. Welcome to the podcast, Perry. How are you?
I'm doing great. Thanks for having me.
Of course. So just want to kick off, give the audience a little background, before dv01, what your career looked like, and tell us a little bit about yourself.
Before dv01 seems like ages ago. My career before dv01 was trading mortgage-backed securities at Bear Stearns and then JP Morgan. So that was in total basically just 10 years, just shy of 10 years on a trading desk after graduating college.
So before we get into exactly what dv01 is, what you guys do, did you eventually see yourself as an entrepreneur, a founder, or did you see yourself in trading most of your career? Did you find this problem and say, I need to solve this?
Well, I think growing up, I always thought of myself as more independent and entrepreneurial. And then I went to college, and then I got really lucky falling into kind of the Bear Stearns internship my sophomore year of college, and that was the first time I sat on a trading floor, and I was pretty mesmerized by that whole experience, and I just kind of got locked into it, and then I was doing well, and I kept on, my career kept on advancing and moving up, and from getting promoted to running a desk and so forth. And so I just never really questioned it. I just kind of felt like this was the thing that I'm good at. So I guess this is what I'm doing. But then interestingly enough, after I kind of, accomplished a few things on a trading floor, I got that entrepreneurial itch, that kind of original feeling of that's what I'm really meant to do, build your own thing. It kind of came back, and that's when, how we kind of, I guess, arrived at dv01.
So tell us a little bit more about dv01, exactly what you guys do, and where does the name derive from?
Yeah, so we are, you could think of us as a data hub in the center of the markets. We interface with originators and issuers, all the banks that trade and underwrite deals, and all the end investors that invest in them. And we have market data sets, securitization data, and if you own your own loan portfolio, all of that could be housed on dv01. But what we do a little bit differently than what existed was we're doing this across multiple asset classes, and we're standardizing and cleansing all the data. And then we've also built all the reporting and analytical tools that you need directly on top of it. So you don't have to be buying data from one place, storing it somewhere else, and then having this, workflow that might, touch a number of different vendors, or, kind of be a mess internally to handle. So, that's what we always envisioned, was to have this one place where all the data sits, because that was the biggest gap that I experienced in the market. It was just the availability of data. And then even if it's available, how accessible is it in terms of like ease of use and being able to derive any kind of insights quickly, and really having access to granular information, but in a non-burdensome way. So that's kind of what we're solving. We started with consumer unsecured, which was a fintech asset class, and that was where we kind of really, need a sector that really needed an infrastructure, and we kind of met that. And then we've expanded it to some of the more traditional ones like mortgage, auto. Solar is a new one that we're working on. Single family residential is another one that we're gonna, so anything that's within the structures product space. The name dv01 is it's actually a finance term. It stands for dollar value of a basis point, so it's a bond term specifically. So when you have a move of a basis point in rates, which is something that is pretty meaningful these days, it's how much does the dollar price of the bond move with that basis point in the opposite direction. So, and that's kind of how you figure out how you're supposed to hedge the security. So that was the name. We kind of fell into it because trying to find a domain name for a company when you start a company is actually one of the hardest things, and that influences the name of your company. So, we were down to acronyms, and then it just hit me, well, if we're using an acronym, maybe we should kind of check this. And dv01.co was open, .com wasn't. And then I guess a few years later, the person who owns .com realized that there's no other bid in the market than us. So he's tried to sell it to us a few times, but at this point we've established ourselves as a .co. So we've given up on the .com.
So, I saw obviously there was some recent news. Tell us about the recent news, and what does that mean? The acquisition by Fitch. What does that mean for dv01 and you, the team? And while answering it, also, what does it mean as a founder to have that type of validation for a name like Fitch, to acquire you guys?
Yeah, there's a lot there. Well, first, what does it mean? It means that we are part of the Fitch and Hearst family. Fitch is owned by Hearst, which is a private company that's operated over 150 years, has a ton of different companies within the family across all walks of life. Media was originally where they got started, but they've expanded into a lot of different asset classes. Fitch being one of their biggest investments or purchases, which they did over a number of years, but finalized, in a number of years ago. And it means that, well, one, I tell this to all of our clients, now you don't have to worry about dv01 going out of business, which is, I think, one of the things we've always dealt with as a startup. Well, that's off the table. And that's interesting to think about, because it's, that's one of the fears you have as a founder always, that, no matter how successful you are, never goes away, because, things can happen very quick in the tech world. But more importantly, it means that, we're very lucky. The way that we structured this deal is to keep dv01 pretty much an independent company. So we could think of it as like we operate within Fitch, and we have kind of strategic alignment with them. We sell to a lot of the same customers. We're in the same market. We're advocating with investors. The business models, shockingly, are very kind of aligned. And you make a lot of revenue, or in our case, most of our revenue selling to issuers, but needing the advocacy of investors. And then there's other things that we could cross-sell investors as well. So they really understood that. So we have a partner that didn't want to kind of mess with our secret sauce as a startup and culture and growth, but really wants to facilitate that growth and help us with it. And the brand is, one of the best in the financial markets. I think the Fitch brand is really, really special, and the place itself is really special. There's countless people that I've engaged with there that are super smart, super talented, and have been there for 20 plus years. So clearly there's something in the water there that people really like. And culture is such an important thing for dv01 that we sensed it immediately, like this would be a great home. And the fact that they're kind of giving us the space to kind of do this, continue on this path, and for our employees and for our customers, that means effectively nothing's really changing. And you can't ask for anything better when you're getting acquired. I think going through the process, we looked at a few other options that would have involved a real integration and into an existing business line, which would have come with layoffs and would have meant like changing some strategic offerings maybe, or getting rid of some offerings, which could affect some client. Like these are all difficult things that a founder would have to deal with normally. And I'm pretty fortunate that I didn't have to deal with a single one of those things. So that's kind of the what does it all mean bucket, both for customers and employees. What does it mean for me as a founder? I mean, it's kind of the thing that you always think about when you start a company. It's a very bizarre but amazing feeling to experience the day that you like think about every day for the prior amount of years. And in my case, it was 8 years since we started the company to effectively acquisition. And I guess maybe the thing I had wrong about it is, it was always like the final destination, but it's not. And that's the wrong way to think about it. Like you get acquired and then you just ride off into the sunset, and no,
on to your next venture.
Yeah, no, and it's funny, and I think a lot of people believe that because everyone asks me, well, what are you doing next? And that's just, I mean, maybe some businesses that are really kind of like more commerce type businesses where it's just like another product line, and the acquirer already has a better assembly line for everything that you want to do, maybe. But for most fintech businesses, I don't think that's definitely going to be the case. I think the founder and the team is expected to continue to stay along, and in our case, we were given actually the resources to keep this going, like as if we were a startup, but not a startup in a sense. Not like all the benefits of a startup without like all the risks of a startup is kind of the environment that we have now. And for me, I realized, I think through this experience that when I think of the vision that I had from day one and continue to have, and kind of how I see us being in the market and interacting with the market, this is just a step along the way that puts us in a better position to accomplish it, because there's still a lot more we have to do. And it was part of the calculus, like, how effective are we going to be at doing this on our own versus having a bigger partner that could help us accomplish all that. And that's what I'm locked in on. That's what the whole senior team is locked in on. And I think it's telling when you don't lose a single person through an acquisition. The deal's been closed for a month now, and we've retained everyone, and we're really excited about continuing this journey.
Back to what you guys actually do day to day, especially on the more on the fintech side. How much since you began to where we are today has the fintech lending space evolved?
Well, I would say, it evolved a lot in probably the first 5 years. And then I think it's kind of been pretty consistent the last 3. I would say when we started, there was, and when we started the company, it was 2014. And, I came from, structured finance background at a bank, and I more of a mortgage background. And I think, I remember when I would talk to clients or colleagues, often treated with a lot of skepticism about this asset class. Who's the person that's taking out a loan online, or who are they originating these loans to? And I think these loans are going to be the first to default in any kind of remotely recessionary environment and so forth. And I'd say it started with that skepticism and really catered to a bespoke universe of investors. It's become fairly commoditized. It is a mainstream Wall Street business, just kind of like any other structured products issuer. And that was always the view that we had, and we knew what that looked like, and we knew where the market was, and we wanted to kind of build the infrastructure to support that vision, which is where we're at today with it. And then I think in many ways, where maybe you could say some of the evolution has come more recently, it's about managing, these downturns. I think COVID, kind of put a lot of hair on people's chests, so to speak, right? It got hairy pretty quickly. And
Yeah.
and I actually thought the response from this community versus more traditional issuers and servicers was head and shoulders above, and how they manage that, and how they, obviously bailouts helped a lot, or the relief packages for consumers helped a lot. But what we saw from the servicers and their ability to kind of quickly iterate, modify loans, work with borrowers, do that so much quicker than anyone else was pretty amazing. And I think now we're going to see I think this is the proper recession that everyone has been talking about for the last 8 years. COVID was a blip for a minute. And then there was a flood of money that came into the market, but this should be the next leg of the evolution for them, is really managing this downturn. How does performance hold up? How do they, work with borrowers, and how do they make adjustments and continue to get investors into the product, and enough loans into borrowers' hands that they could support the businesses?
Do you think that having a technology reporting and analytics that you guys provide help lenders and servicers deal with like a COVID or even a recession a lot better than say back when you were at, Bear, or back in the days of 2008, 2009, which obviously came to a crashing halt? But what does it mean to have that type of intelligence and that type of actionable data? When you said it yourself at the beginning, it was hard to parse a lot of that data back when you were at the banks.
Yeah, I mean, I've actually been saying this a lot lately, and I'm not talking my own book, so to speak here. I genuinely believe this. And what I've been saying to a lot of issuers, because in fintech we have over 90% of the market, so there's not really much of an audience to talk to that's not on the platform. So in the mortgage market, we still have a lot of room for growth.
Mhm.
And what I say to those issuers is that, and we saw this firsthand during COVID, is that in absence of transparency, people assume the worst.
Yeah.
Right? The narrative, when markets get really scary and volatile, and you kind of have these, like, people's minds go to really dark places and what's going to come, and it's doomsday and it's all over. And if there's no information, or information is not accessible to prove them wrong, then they're going to go with that. And what that usually results in is selling of assets and not buying anything, and then results in these kind of, these negative price pressures that send things down, trip, different kind of technical levels, result in more selling. And it's kind of a cycle that goes, and it's tough to break. And COVID was really an example of that, because there you had a really bad scenario. People assume the worst, right? And with consumer unsecured, it means these guys are the first to puke up. And because I think these servicers and issuers are just ahead of the game data-wise. We're getting nightly data from a lot of these counterparties. We were able to put out biweekly reports, updating people on performance. And you could do it in the app too. There's a lot of transactions that are real time on our platform, like Lending Club certificates. That's daily reporting. People who have loan portfolios were getting daily reporting. And what you saw was that it wasn't getting worse, and it was counterintuitive. And for a while, we were all puzzled by it. And then it started to make sense, right? There was a lot of stimulus. People had extra money. They stopped going out. They were saving money, and actually they weren't defaulting on anything. And so it very quickly, things tightened up. And I'd say the consumer market, actually got straightened out faster than the non-QM mortgage market, where it took a while for investors to know how servicers were engaging with the borrowers, what was going to be modified. There wasn't, one thing that we did with all the consumer issuers was basically talk to all of them and talk about how we're going to normalize the modification reporting. It was so much easier for investors to understand what was happening in the consumer unsecured space than it was in the non-QM space. And it took a year for us to even understand what was going on in the non-QM space. And I think that's a reason, you didn't see a single one of these consumer issuers go out of business during COVID. And it was you almost saw a bunch of mortgage REITs go out of business. You didn't see a single one of what is thought of as a riskier consumer originator even, flirt with it. So now we're in this same position where the markets are really messy, but performance is actually not that bad. And I think, what we say to a lot of these mortgage issuers is you should be telling your story out there, but if you're just doing it with your own PowerPoints and slides and stuff that you computed on your own, it's a little tougher for people to trust that. And you should have a third party where the data is there and pull charts from our platform. And you see that in consumer world. A lot of issuers are pulling charts off of dv01, comparing their performance to the benchmark and so forth. But more importantly, the investor community could do it all themselves and trust it, that they're not being, adversely selected, really friendly charts. It just brings down the skepticism level.
Yeah, obviously we're talking about a potential recession, whether or not we're in one, and what that might look like between now and the next year or two. You were working at the banks back in 08, 09 time period. Do you think that some of the lessons that were learned coming out of that will stop people from making some of the same mistakes they made back then? And the technology advances we've had between now and then, we were touching on some of them, does that help potentially eliminate some of the mistakes that were made back then?
Well, I think it depends what market you look at. I would say in the mortgage market, for example, because that's a big one, I think it's going to be tough to repeat that just because that underwriting was really crazy. And I think from a origination and underwriting standpoint, there were some real lessons learned about what type of loans are we not getting into again. And for the most part, even in a period of super easy money like the last 2-3 years, you didn't see that come back. In fact, maybe I would say, you saw people reaching on consumer underwriting a little bit more than the mortgage guys, because the mortgage guys, have been down that road before. And maybe that's what the consumer people need to figure out. But on the technology side, you haven't really seen it with the mortgage people. I think people are still stuck in their old ways and, kind of, will hang their hat on the underwriting and just saying, well, it's not the same type of loans and the performance is a lot better. But again, in any bad environment, people become suspect about everything. And you need to be able to give them that transparency so they could actually see what's happening. And even if the performance is bad, it's like, even like we're seeing some pockets in consumer right now that aren't great. And it might look bad for an issuer. So this is where, again, even in bad performance, I think it's important to have the data on dv01 or just a platform, make it transparent, is because you could then at least isolate where the bad performance is and put a box around it and say, listen, our numbers, because some of these, I see it when a lot of these companies are public now, our clients, right? And they get crushed by the equity analysts that just talk about, delinquencies across the whole platform and aggregate. But that could be driven by a very specific segment of loans. And what that does is it kind of throws it all out, and makes it all look bad. When in reality, you could say, no, look, here's where the delinquencies are coming from. It's this demographic. We know exactly what's going on. We're handling it. We're changing pricing, or we're just not originating to this type of borrower anymore. So it allows you to kind of really focus the conversation around what's what, as opposed to just overall delinquencies are up, which just makes it look like everything is falling apart. And that's usually not the case.
Since launching, what's the top 2 or top 1 lessons that you've learned since founding dv01 to, say your time that you were acquired by Fitch?
I think about this question all the time, and every time, like when it gets asked, I kind of freeze because there's so many, and I think on different days. Listen, even post acquisition, it's business is tough, or I guess maybe you could take some of the stress off the table. That not everything is going to be kind of it's not an existential threat to the business, but I think one of the most important things is for a founder specifically is and what served me really well is that your own personal well-being is a huge component of your company's well-being. When you are the founder, you are kind of the life source or energy of the business to a degree. Every interaction you have is under a microscope. And sometimes you lose track of that because when the company is small, it's like kind of there's not this like I'm the founder and it's like we're all a few people in this room trying to throw this shit against the wall and make it work. And then next thing you know, it's, as things grow, you're kind of, that's not the case. You're the CEO. And for anyone that you're chatting with, it's an interaction with the CEO. It's maybe one of the more meaningful interactions they're having that day or that week. And if that's a bad one, because you were in a bad mood about something, or, you lost your shit somewhere else or something like that, like that has a way of spreading through the company. So I always kind of, especially I think like the first year or two, your job is mostly doing because you're doing 5 different roles. And then as you start building a team, your job goes from doing to thinking. And when your job is more thinking, you really have to make sure that your mind is in a pretty good place. Otherwise, you're not going to think effectively and you're not going to be able to engage with people effectively. So my view, I always say when people say, what's one of your biggest responsibilities is just to make sure that every day I come into the office and my head's, screwed on right. And that whether that means, kind of like some sort of wellness practice, mentally, physically, for me, it's all of the above, working out, meditating, all that kind of stuff so that I could be focused here and make sure that that's what I'm channeling into the company as opposed to, being toxic to the business.
Is there a top regret since you've launched?
Top regret, maybe not self-funding the business a little bit more. Just to have more equity. It's kind of one of those things when once I've dealt with this a lot recently. A bunch of my seed investors, I should have invested more. I go, well, tell me about it. I shouldn't have taken your money. I should have just invested it myself. But no, I mean, the good, bad, and the ugly is in my mind, I mean, all part of it, right? And I think there are times, and if you're a founder listening to this and you're in one of those where it's really bad and you have some sort of regret or you think you messed something up, just you have to realize that that's part of it. And you won't understand why, but that's I find with my team, and we've just gone through this period of doing a lot of reminiscing, the good moments along the way, like you signed the big contract or, you broke some revenue. I mean, you don't even really reminisce about those. What you're reminiscing about usually when it works out at the end is all the different moments where it could have all fallen apart.
Yeah.
And they're funny, believe it or not. So it might be painful right now, but at some point in the future, they will be really funny and they will be the moments that you cherish the most with the people that you went through them with, whether they're still with the company or not. I've definitely, done a lot of reminiscing with former employees too. And, and again, everyone has their role on the journey. I think whether or not they're still at the company or they left or whatever, having those kind of keeping those relationships in a good place is really meaningful, because at the end of the day, you will look back on those moments together.
Speaking of people, what does the team look like today? How big is it? Where are you guys located overall? Tell us a bit more about those that are working with you at dv01.
Yeah, I think this number changes often, but I think we're in the 125 to 130 range is
Wow.
probably the approximate. We're all over. I mean, I think we still have a pretty big concentration in the tri-state area of New York, New Jersey, Connecticut. We were a New York-based company pre-COVID with a pretty, sizable office space in New York, and then COVID happened and people started moving a little bit. A lot of people that were in the city moved to the suburbs, and then we weren't. And I mean, I even moved to Miami, but we were thinking about coming back to the office, but we just couldn't force people back to the office, and we also couldn't hire in New York exclusively enough.
Yeah.
And it's funny, it's a very different employment market now, but 2 years ago and a year ago, even, it was really, really tough. And so we decided to go fully remote because we needed to. And we also didn't want to, try to make a return to the office play, because we just hired all these people that were not in New York. And we didn't want to have kind of this like second class citizen type situation where you had a bunch of people in New York in an office and then remote employees. We wanted to really make sure that we were building a remote first culture from the ground up. And we have an office space in New York. We call it a clubhouse. It's not even really a full-fledged office. There's nothing mandatory about it. People could just sign up and come as they please. We'll have some events there, but it's yeah, it's just a very different environment now. And I'm not totally sure what the verdict will be on this. I think we're starting to see some remote fatigue. I would say to a degree. There's actually not really. What am I even saying? I hear that from other people, but within our company, we haven't. And I think people appreciate the freedom that they have. But I do think it's important to bring people together. I'd say that's maybe the thing that I sense with our employees is not necessarily a fatigue from remote, but because they enjoy that freedom that they have there, but a desire to be around their coworkers a little bit more, but not necessarily through working in an office. But
Yeah.
we had an offsite that was amazing. We're having a holiday party, and then we'll have different team offsites. So it takes work. It's definitely a lot more work to make sure the culture is right, as opposed to when you're in an office, you could just be pretty lazy about it and just, this is our culture. It's
Yeah.
whatever's happening in the office.
A lot more intention when you're not with everyone on a daily basis.
Yeah, exactly. It is way more, I would say, engineered, the culture, than it is just kind of on its own serendipitous.
You've obviously had a number of fundraising rounds. You've had an acquisition. How different or what's something that you learned from those early fundraising days to the acquisition, kind of that evolution of, all right, now I've got my business locked in, we have some traction, versus when I'm just pitching this idea?
Um, the sale process of a business is way different than a fundraising process. I mean, orders of magnitude different in terms of depth and detail. And in many ways, I think it would be helpful to understand what that process looks like. One of the things I was thinking about when we were going through it, and we worked with bankers, we were very fortunate that Jefferies was one of our investors, and they actually happen to be phenomenal in the capital markets fintech space. So it was a natural fit for us. But when we worked with them 3 months before we really talked to anyone, and getting the numbers right, the sim right, and when you're working with bankers and you understand what they're looking at to help kind of tell the story of the business, some of the stuff was like, wow, I never really thought about the business this way. I mean, it would have been helpful if maybe I knew this a few years ago, and it would have changed maybe some of the metrics and KPIs we were looking at internally, sharing with our board. So I think it just brings a level of discipline. So I would think, even if you don't really have intent of selling your business, chatting with bankers along the way just to kind of understand what they think potential acquirers would be looking for, and how they're thinking about your business is really helpful, because it's usually it's definitely, I'd say, different than what we experienced during the venture capital raises. I also think another thing is, again, we got really lucky that we kind of we didn't go through a formal process. This kind of all started because someone was interested. It made us think about it and then go through this process with bankers and invite a select few. But I could have definitely done a better job having some of those relationships earlier on. So knowing who your potential buyers are. We got really lucky. Fitch was not someone we chatted with in the 8 years that I'd operated the business. They were, interestingly enough, a client. And so we had a commercial relationship with them, but we didn't really have a corp dev relationship with them. So there was kind of like this, well, this is a little fast and not usually how we operate, but I think we built a lot of trust and over a couple of months, we really got to know each other and we felt culturally aligned. And I think that gave everyone a lot of comfort, but there's no doubt it would only have helped if I'd made some of those relationships a couple years earlier. And I don't know, as a founder, you always kind of put it off. Well, I'm not ready to sell. It doesn't work that fast. So you don't have to be ready to sell. This is all just about, it's easier dealing with someone if you've known them for a little bit longer. So don't worry, it doesn't bring extra workload to you. It's just literally managing a relationship.
Any fundraising horror stories?
Oh yeah. I think every founder has the round that was scarred them. For us, it was our Series A. We had a term sheet. We were negotiating it. It evaporated mid negotiation. It actually started. We were talking to a strategic partner. They pulled us along. Didn't work out. Then got a term sheet from an investor that we were familiar with. We're negotiating it. It evaporated. So then I had kind of a couple months to start a formal process. And I mean, it was the one where I talked to everyone out there and it seemed pretty dire, like it wouldn't get done. And we got it done, and we actually got it done. We had 3 venture funds in that round: OCA Partners, Ribbit, and Illuminate. And so it became oversubscribed, but it's like, your typical, you have a lot of follow-on interest, but you need someone to lead it, and finding that lead was the tough thing. And OCA came in and led that, but that was the round that like really almost killed me personally. And then, from there, we were really lucky. Pivot Investment Partners came on, a little piece in that A as a follow-on, but then led the remainder of our rounds, the B round, and then there was a few follow-on Bs. So it was really easy with them, and we never really had to go to market again. Our seed round was interesting too, just because at that point, we have a complicated product, and I wasn't really good at pitching it yet. And we had Soros was in as the lead, but we tried to get other venture funds in, and I just fumbled the ball every time trying to explain it to them. So it ended up being Soros and then a bunch of like my friends and family, which now is great because they all did really well on the deal. But and we had one other fund, Clock Tower. They were the only ones that got it because they come from a capital markets background. So I would say, I mean, rounds were tough, and I think fundamentally it's structured in a way which is really mentally difficult to deal with. You will hear 60 times more no's than yeses, or 99% of the convos you have will lead to a no. And I think earlier on, that's a lot tougher to stomach because it's an idea. Maybe it gets easier as the business is.
And you're trying to build that idea all at the same time while trying to pitch the idea.
Right. And I think when it's an idea and in your mind, it's obviously a bit more sacred, right? So when someone kind of wants to, say your sacred idea is not worth it, that hurts. And then, I'd say it's a little bit different when you have a business and you have a revenue stream and you have a business model and everything, and someone says no, well, then it makes you insecure about like, is this going to fall apart? Like, maybe I have this wrong. Am I thinking about it wrong? But it's tough. I mean, I think it's tough on both sides, right? And I think my advice, because now I also Fitch also has a ventures group, so I've been fortunate in chatting with some other founders that they're chatting with, and I've also talked to a lot of founders on my own. But one thing that I think that I always is, and I think it's important, especially in these markets, is being really authentic about what's working, what's not, what do you have, what don't you have. I think being on the other side, it's really tough to there's a lot of people that just will present a really rosy story, but that's impossible.
Yep.
I don't, like, you talk to one operator who any part of their business is rosy and smooth. It just doesn't exist. So, and if you're framing it like it is that way, well, then we know that's not true. And then it makes us suspicious about everything. So I think and my investors always kind of love this about me, maybe too much, was I always kind of wore it on my sleeve. You knew if things were going bad. I couldn't hide anything. It's very clear if things were going well or they were going bad. And they're bound to go both ways. I'd say more often than not, they're not going well. And then you have these few moments when things are working and they're short-lived, and you enjoy those because they're very short-lived, and then boom, you get hit with more adversity.
We have just a couple of minutes left, so I'd like to end a little bit lighter. Do you have a favorite book or the last book that you read?
The last book that I read, well, it's funny because I hop around books pretty frequently. So I don't know when I actually finish something because I jump in and out of books. But right now I'm reading this book called The Divine Matrix. It's an interesting book. If you're a spiritual person, put that out there. I'm also reading this book. I forget the title of it, but it's about the Shah of Iran and the history of that on Persian. So it has some personal value to me. Did I answer that question? Was there a second part to that question?
Nope, that's good. I mean, you mentioned this before in terms of unwinding and mental health, but meditation, I presume, is the thing you do to unwind and kind of step away.
Yeah, I think, and look, there's a lot of different kinds of meditation. I've definitely done a ton of different things. Meditation and exercise, to me, those two, the exercise, because it's especially if you do something strenuous, it's you're thinking about that and how you might not be able to survive whatever exercise you're doing. And if that's what you're thinking about, you're not thinking about work, and you just need to shut it off in your head, however which way you can. So however that works for people, whether it's time with their families, whether it's meditating, exercising, reading, I don't know, but you just, because it's tough to shut this stuff off in your head, and it really takes only a few things that could have the ability to do that.
Do you have a favorite sport or sports teams that you root for?
Yeah, I'd say the Yankees are my team. I mean, as brutal as that's been the last couple of years, but they are my favorite team. I would say baseball in general isn't my favorite sport, but I find football and basketball way more fun to watch. But the Yankees are definitely my team, and it's been heartbreaking few years.
Do you have a favorite vacation spot?
I'm lucky. Miami is, I mean, every time I even travel out of Miami, I miss Miami, which is a new phenomenon. I'm used to living in New York, going on vacation somewhere, not wanting to come back. But if I had to pick a place outside of Miami that I'd go to, is probably Italy. The Amalfi Coast is a special place.
You mentioned, you're Iranian. Have you ever been to Iran?
I did once, high school. 2000 was the year.
How was that?
It was an awesome experience. It's really unfortunate thing. The country is an amazing place. The people are amazing. Most of the country is young and hates this government, and you're seeing it this last month of protests, particularly around women's rights. So I can't even imagine what it would be like if it was just a normal country and people could go visit there and it wasn't backwards like it is, but it's a beautiful culture, and I'd love to go back sometime soon.
And then final question, biggest inspiration in life?
Biggest inspiration in life. Wow. I just didn't even prepare for that question. What do you mean exactly?
What inspires you?
What inspires me? Helping people, really. I think whether it's by actively helping people, whether it's, doing stuff like this and people find value in something I said or something I post on Instagram or whatever it is that, maybe helps them in that day or, over the course of a career, which is nice. I got a message like that, some advice I gave someone really, help them think about their career differently. So that's I think what keeps me going, and specifically for my employees too. It's one of the things that we do is we're pretty transparent about the company. We post all the board decks. Any questions that we have, we don't really, other than comp, everything is pretty fair game, because we want to, and for me personally, it's I want to help people who might want to start their own businesses understand what it takes. When I started the company, I didn't know what goes into a board deck, and what we had to do or how we have to think about the business and so forth. So, that's something that we specifically focus on within dv01 as well.
Well, Perry, thank you for taking a few minutes out of your day. If someone wanted to find you or find dv01, how'd they do that? How can they reach out?
I'm Perry at dv01.co. And then dv01 Inc. has an Instagram if you want to reach out, and a LinkedIn page. But feel free to email me.
All right. Well, thank you again. Good luck with the the continued acquisition, and hopefully we'll get you back sometime in the future.
Love it. Thank you so much.